main macroeconomic news, barring fresh updates on the ongoing coronavirus outbreak, will be the latest Purchasing Managers Indices, or PMIs, for the UK's manufacturing, construction and services industries. They are due out on March the 2nd, 3rd and 4th, respectively. Now, the PMIs are potentially useful because they're a lead indicator for the economy. This compares to concurrent indicators like retail sales or industrial production, or lagging data like unemployment and GDP numbers. Remember that with the PMIs, a score over 50 is seen as indicative of growth, one below 50 as one that warns of a contraction in activity or even a future slowdown or recession. As we can see here, the general trend in the UK figures since the EU membership referendum vote had been one of fairly persistent weakness. That said, we've just started to see the first tentative signs of improvement in the wake of both December's general election and January's confirmation of the UK's departure from the economic bloc. And now please don't take that as a statement of political preference, by the way, it's just how the numbers look. And also don't forget, a bad start to the Brexit talks between London and Brussels, or a wider than expected spread of the coronavirus, could easily snuff out the nascent improvement amid any economic disruption worldwide. Anyway, last month's PMI readings for the UK were as follows. Manufacturing rose to 50, the highest mark since April 2019. Construction rose to 48.4, also the best since last April. And services hit 53.9, the loftiest reading since September 2018. Now, in terms of company news, around a dozen FTSE 100 firms are due to release interim or full year results or host an analysts meeting, and a number of mid and small cap companies are scheduled to do the same. The events which could prove particularly informative include the following. Figures from United Utilities and non-life insurer Hiscox on Monday the 2nd of March. Then we've got Ashtead, Intertech, snack seller Greggs and recruitment expert Robert Walters on the 3rd. Life insurer Legal & General, Severn Trent and gold miner Polymetal on the 4th. And another life insurer Aviva, as well as bookmaker GVC, Melrose Industries, non-life insurer Admiral and stricken healthcare services provider NMC Health on Thursday the 5th of March. But for me, the stock that's perhaps capable of causing the biggest fuss in the week ahead is ITV. The broadcaster is scheduled to report its full year results on Thursday the 5th of March. As we can see here, the shares have really not done terribly much over the past 12 months, even if they've been volatile, and they're actually trading no higher than they were in spring 2013, thanks to concerns over competition from rival streaming services, the renewed increase in the company's net debt pile after a string of acquisitions, and the general state of the UK economy. ITV's advertising revenue is pretty sensitive to both audience share and also the British economy, so the numbers will be particularly interesting for this and quite a few other reasons. This chart shows the ITV share price, by the way, against the monthly UK GfK Consumer Confidence Indicator over the last 10 years. Make of that what you will. Anyway, when it comes to the numbers, the first one to watch will be the top line sales figure. Analysts are looking for revenues of around £3.2 billion, pretty much flat on last year. But that does imply a year-on-year increase for the fourth quarter. Remember, total revenues were actually down 2% at the 9-month stage. Attention will then shift to the sales mix beneath the headlines. At the 9-month stage, broadcast and online sales were down 3%, with advertising down 3% and online up 23%. Boss Dame Carolyn McCall has forecast that ad sales will be flat to up 1% in Q4 and down 2% for the year overall. The 2019 Rugby World Cup will have helped. ITV Hub is ahead of plan with 30 million users, and 2020 will see ITV broadcasting the European Football Championships. Meanwhile, ITV Studio sales were up 1% at the 9-month stage, and ITV still expects 5% growth for the full year. Dame Carolyn expects a similar 5% growth rate for 2020, albeit with a second half weighting. Now, after the focus on sales, analysts will then obviously switch their attention to profits. The current consensus forecast is for a slight increase in pre-tax income to £604 million against £567 million in 2018 on a stated basis. For 2020, by the way, a tiny drop is analysts' current best guess, down to £596 million. The final focus point will then be the dividend. CEO Dame Carolyn McCall has targeted a dividend of at least 8p a share, the same as 2018. There have been no hints for special dividend after 5 consecutive such payments between 2012 and 2016. Other points to watch for include comments on the plan to cut costs by between £55 and £60 million between 2019 and 2022, an update on the BritBox streaming subscription service which launched with the BBC in the UK in November, and any guidance on the programming budget which was due to come in at £1.09 billion in 2019, a fraction below previous forecasts. Thank you for watching, and I look forward to seeing you next time.